On to your markets news now. Asian markets traded lower today. This on concerns that the US Fed may continue with its hawkish stance on monetary policy following a solid performance in US retail sales. And that's despite a lower than expected consumer price inflation print recorded for October. Tech stocks also drove stock prices down. The Nikkei share average ended 0.35% in the red. The Hang Seng index declined by 1.15%, while on mainland China, the Shanghai Composite Index closed down by 0.15%. Over in the United States, the S&P 500 fell on Wednesday as a grim outlook from Target spurred fresh concerns about retailers heading into the crucial holiday season. Micron Technology shares dropped after the company said it would reduce memory chip supply and make more cuts to its capital spending plan. The S&P 500 lost 0.83%. The Nasdaq Composite lost 1.54%, while the Dow Jones Industrial Average fell by 0.12%. Stocks on the JSE are trading higher. The all-share index is 26 points higher at 72,633 points. Financials added 0.3% and the industrials 25 index a tad lower. European markets are mixed at this hour. Britain's FTSE 100 has lost 0.4%. The CAC 40 in France is down 0.5% and the German DAX is 0.25% firmer. Looking at commodities, gold is trading at $1,762 and platinum at $997 per ounce. The price of Brent crude oil is trading at around $92.50 a barrel. Taking a look at the currencies, the rand is trading at 17.47 against the US dollar, 20.70 against the British pound and 18.06 against the euro. To break down what's happening on the markets for us, I'm joined by Han Ten. He's the Chief Market Analyst at Exinity. Thanks very much, Han, for joining us. So why are market players concerned about the latest US retail number, of which, I think it was up at around 1.3%? Why is there so much excitement about that retail number?
Right. Keep in mind that we live in a world right now whereby stronger than expected economic data is actually bad news for risk assets. The reason being, when you have a more resilient US economy, then you've got a Fed that has been given a green light to keep hiking its interest rates, and risk assets, including stocks, they don't like the prospects of those higher interest rates. Hence the reaction that we're seeing in US stocks right now and around the world as well. They are essentially hitting pause on their initial excitement following what you mentioned earlier, that cooler than expected inflation data that we got last week.
So I suppose with speculation that the Fed will continue to push hard on rates, this is why we're seeing a stronger dollar today. To what extent do you see this impacting on emerging market currencies like the South African rand?
Yeah, to be fair to emerging market currencies, they have enjoyed some reprieve, at least on a month-to-date basis. Most of them have a gain so far this month against the US dollar. But if you take a longer time frame, comparing the performance so far this year, they obviously have a long way to go. And so until the dollar continues declining, and that will be contingent on markets saying that, yes, the Fed is indeed done with their rate hikes. Until that narrative really takes a firm grip in markets, emerging market currencies would have a tough time registering significant gains. And I also keep in mind with the fears of a potential global recession in 2023, that would only weigh down on emerging markets.
So let's take a look at China, which is, of course, the second largest economy in the world. That economy grew at a massive pace for over 30 years or so. And then since COVID, things have slowed down for it. We know that the Chinese government has been trying to stimulate that economy, but there are fears now that even though they're at a lower base than the rest of the world, inflation is going to go up. So it's going to cause a bit of a problem in terms of providing that stimulus that economy needs.
Yeah, and you're indeed right. So I guess in that sense, the PBOC has the luxury of perhaps learning from the rest of the world, which is essentially contending with these stubbornly elevated inflationary pressures. So as you suggested, what it means is that the PBOC may be less reluctant to continue supporting the sluggish economic recovery in China. And so while that may be perhaps a drag on economic growth overall, at least they may be able to sidestep or at least limit the impact that surging inflation might have, just like it has on the rest of the world.
So with the narrative changing every day about the prospects for the global economy, how do you see commodities markets faring, particularly oil, which has really been quite volatile?
Yeah, so oil prices really have been stuck between push and pull factors, right? If you look on the supply side, there are enough reasons to think that oil prices should remain supported, and I'm in that camp as well. And by supported, I mean around this $90 per barrel levels. You've got OPEC Plus that is willing to tighten supplies. You have the prospects of the EU ban on Russian crude coming into effect in just a couple of weeks in early December. So that's supportive. But on the demand side, again, we go back to that recession story. If we do get fed more signs that the world economy is indeed headed for a recession, then I think that could really weaken the floor, or at least put a stronger ceiling above oil prices. And that's why you're seeing Brent futures really struggling to break back into the $100 per barrel levels really since late August, so for the past couple of months.
Yeah. And then just one last one, Han, just in terms of the incident that took place a couple of days ago in Poland, those bombs going off and 2 people dying. There was a lot of uncertainty. Markets did react initially. Have things calmed down in that regard from a market perspective?
Yeah, I think overall markets have shown this propensity to have these knee-jerk reactions, right? Not just to geopolitical tensions, but also, as we've seen, to economic data as well. But I think for the developments surrounding the Russia-Ukraine tensions, I think that's markets are well accustomed to that storyline already. They've had all year to really digest it. I think that has been taken a backseat somewhat compared to the prevailing story, and that being the focus on the Fed and what it intends to do with U.S. interest rates.
Indeed. Han, thank you very much for your time and insights. As always, Han Ten, he is a market analyst at Xinity. We're going to go for a quick break.